Hey guys, welcome back to the channel where we make legal concepts simple and accessible. Today we are diving into the Securities and Futures Act of Singapore, specifically discussing what it means to make an offer of securities, the exemptions from prospectus requirements, and the rationale behind these rules. Under the Securities and Futures Act, an offer of securities refers to any proposal to sell or issue securities to the public or a specific group of people. Securities can include shares, bonds, or units in a collective investment scheme. These are financial instruments that allow people to invest their money in exchange for potential returns. For instance, if a company invites individuals to buy its shares so that it can fund a business expansion, that constitutes an offer of securities. Offers can be public, meaning open to everyone, or private, which means they target a specific group of investors, such as institutions or accredited individuals. The rationale behind regulating offers of securities is to ensure transparency and to protect investors. Providing sufficient information about the risks and financial health of the issuer allows potential investors to make informed decisions and reduces the likelihood of fraud or misinformation. A prospectus is a legal document that offers comprehensive details about the securities being issued, including the company's financial performance, business strategy, and potential risks. Its primary purpose is to protect investors by ensuring that they have access to all relevant information before committing their funds. However, preparing a prospectus can be costly and time-consuming. Therefore, the Securities and Futures Act provides specific exemptions where a prospectus is not required. These exemptions aim to balance investor protection with the need to promote efficient capital raising for businesses. One exemption applies to small offers that do not exceed $5 million over a 12-month period. For example, a small tech startup seeking $4 million from angel investors does not need to prepare a prospectus. Similarly, a boutique food company raising $2 million for equipment upgrades can bypass this requirement. The law considers these offers manageable in terms of risk, given their smaller scale. Another exemption covers private placements, where securities are offered to no more than 50 people within a year. This is common in scenarios where a mid-sized company seeks funding from a specific group of high net worth individuals or a venture capital fund. These offers are targeted at investors who are more likely to understand the risks involved. Another significant exemption applies to offers made to accredited investors. Accredited investors are individuals or entities that meet specific financial thresholds, such as having a net personal asset value exceeding $2 million or an annual income above 300,000 Singapore dollars. For instance, a hedge fund might offer investment units exclusively to high net worth individuals meeting these criteria. Similarly, a real estate developer could issue bonds targeted only at accredited investors. Since these investors are considered financially sophisticated, they are expected to perform their own due diligence without needing the protections of a prospectus. Offers made to institutional investors such as banks, insurance companies, or large fund managers are also exempt. For instance, a government bond issuance aimed solely at pension funds or a tech company offering convertible bonds to global investment banks would not require a prospectus. Institutional investors are assumed to have the expertise and the resources to assess the risks of such investments independently on their own. Additionally, exemptions exist for certain employee stock option schemes or securities issued to a company's directors or employees. These internal arrangements pose minimal risk to the public and are therefore not subject to prospectus requirements. The exemptions from prospectus requirements reflect Singapore's pragmatic approach to balancing regulatory oversight with economic growth. By easing the regulatory burden for smaller or targeted offers, companies can raise capital more efficiently, saving on compliance costs and time. This promotes innovation and supports businesses, particularly startups and small to medium-sized enterprises, while still maintaining robust protections for retail investors. However, it is important to note that these exemptions also mean less mandatory disclosure. Investors participating in such offers must exercise caution and conduct their own due diligence. Singapore's regulatory framework under the Securities and Futures Act creates a pro-business environment while ensuring that investors, particularly retail investors, are safeguarded. It is a thoughtful balance that has contributed to Singapore's reputation as a legal global financial hub. Understanding these rules empowers businesses and investors to navigate the securities market more effectively. That's all for today's discussion. Thank you for tuning in, and I'll see you in the next video.